Welcome back to Economic Outlook. Today we're going to conclude our series on commodity trading by looking at exactly how investment dollars flow into commodities. We'll start by talking about commodity index funds. These allow institutional investors to diversify their portfolios through commodity holdings. After that, we'll try to quantify exactly how much money has flowed into commodities over the past few years, and ultimately, we'll look at the effect that these capital inflows have on commodity markets and on consumers. In our last discussion, we saw why commodities have become more attractive for institutional investors. The last commodities boom in the early 1970s was caused by supply shortages and geopolitical instability. The most recent boom, however, has been partially fueled by rising demand in developing countries like China and India. This has changed the long-term fundamentals of supply and demand and has helped to attract institutional investment. At the same time, these institutional investors have realized that commodities offer valuable portfolio diversification. These two factors combined have helped increased interest in commodities and helped them develop as a genuine asset class. Investing in commodities is different than investing in equities. It's very easy to buy and hold equity stakes in companies as investments. With commodities, though, you can't necessarily do this because you have to purchase futures and ultimately take delivery of the commodity if you let your future expire. The main way companies and institutions invest in commodities is through index funds. A company will allocate a certain amount of money to an index fund, and it's the job of the fund manager to research and execute trades to create a portfolio of commodities. This portfolio essentially buys the market and diversifies the risk between the different commodities. Let's look at the structure of an actual commodity index fund to see how they work. Commodity index funds are typically created by purchasing a series of long-only futures contracts. Index funds very rarely take physical possession of the commodities that they invest in. The fund manager will purchase futures, and then, as the contracts near expiration, he'll sell the futures and use the proceeds to buy a new set of futures with later maturity dates. This is called rolling contracts. Also, commodity index funds are unlevered and typically are highly collateralized with T-bills. Commodity fund managers are able to keep open positions in the market by continually rolling contracts as they near expiration. Because they're constantly rolling contracts, they tend to invest in commodities that have highly liquid markets. That way, it's easy to enter and exit positions when contracts are nearing their expirations. Let's look at a few real-world commodity index funds and examine their compositions. These 5 commodity index funds all have very different characteristics. For example, the ASMAX Commodity Index, or AMCI, is denominated in the Japanese yen and focuses on liquidity. The same can be said about the Reuters Jefferies CRB Index and the Deutsche Bank Liquidity Commodity Index. All of these focus on finding commodities with high liquidity and very active trading. The two most popular indices are the Dow Jones AIG Commodity Index and the Goldman Sachs Commodity Index. The Dow Jones focuses on liquidity and is extremely diversified. Each commodity must compose between 2 and 15% of the fund's total composition. It also has many sub-indices if companies want different exposures. The Goldman Sachs Commodity Index is also very popular, and its commodities are weighted by the relative significance of each commodity in the world economy. As the chart shows, commodity index funds have a variety of compositions. Some funds, like the Goldman Sachs Commodity Index, are heavily weighted toward energy and also have a lot of total commodities, 24. The Dow Jones AIG Index is similar, with 19 commodities, but has less focus on energy and is more distributed between metals, agriculture, and meats. Other indices have even fewer commodities. The Deutsche Bank Index has only 6, and the AMCI has 9. Commodity indices can treat the same commodity very differently. Let's take a look at gold, aluminum, and crude oil within the 5 indices we just saw. As you can see in this chart, each index treats the 3 commodities very differently. The Goldman Sachs Commodity Index is heavily weighted toward crude oil, with little weight assigned to aluminum or gold. The AMCI, however, has a higher percentage of gold than crude oil, and the Dow Jones AIG is fairly evenly weighted between the three. The different weights assigned to different sectors are very important when commodity indices try to roll their contracts. Let's look at this composition in more detail. To show how commodity index funds differ in their allocation of resources, I put together a chart for each index, showing the weight it assigns to each commodity sector. As you can see here, the Goldman Sachs Commodity Index is heavily weighted toward energy, with little weight assigned to agriculture or metals. The other main index, the Dow Jones AIG, is more evenly balanced, with 34% of funds devoted to energy, 30% to metals, and 29% to agriculture. Other funds have different percentages. The AMCI is more heavily slanted toward metals, while the RJCRB focuses on agriculture and energy. Ultimately, the weights assigned to different commodity sectors within an index will determine how effective it is in diversifying risk associated with the commodities it contains. As we discussed briefly before, commodity index funds have to constantly roll their futures contracts to keep consistent, open positions in the market. As you might expect, it's difficult for a large fund to roll all of its contracts in a short period of time, so it usually breaks the process up over a period of days. A large fund might trade 20% of its contracts each day for a 5-day period. It's important for these large funds that they invest in commodities with ample liquidity so that they can find counterparties to all of these transactions. Additionally, since the roll dates for commodity index funds are generally laid out in the prospectus, it's possible for the market to move against large rolls. Usually, these disruptions are temporary, and the market will quickly correct itself after a large fund rolls all of its contracts. When index funds roll their futures, they create a great amount of open interest. Open interest is simply the number of active commodity contracts which haven't reached their maturities or been settled for cash. A way to quantify the amount of open interest is to look at the amount of the physical commodity it represents. Then, we can compare this amount to the world's annual production or to the amount in an exchange's warehouse. Let's look at 2 examples to see exactly how this works. The London Metal Exchange deals in a number of commodities, and I've listed 5 of them here for our example. Let's look at lead. There are 135,000 lead contracts trading on the exchange right now, and they're each worth 25 tons of raw materials. This amounts to 37 times the amount of lead available in LME warehouses and equates to 51% of the world's annual lead production. This is even more extreme for other commodities like zinc, where the 375,000 open lots represent 103% of global zinc production. Another good example of open interest is with corn futures. Right now, there are over 1.2 million open corn futures contracts. This represents 137 million tons of corn. That's 51% of America's annual corn yield. Now, most of these contracts will be settled long before the owner of the future has to take possession of the commodity. However, the large amounts of open interest amplify the effects of supply and demand and contribute to price volatility.